China is the largest market for cars globally. People say that China is going to completely take over the electric vehicle industry, but that's not true. In reality, many EV companies are going out of business every day, with over 400 companies already shutting down. Thousands of electric cars are being left abandoned in fields throughout the country because they're falling apart. Let's examine the biggest EV market in the world and find out why 90% of Chinese EV manufacturers are going bankrupt. Welcome to EV Digest. China was quick to catch on to the electric vehicle trend. Back in 2018, the Wall Street Journal reported that there were around 487 EV manufacturers operating in China. This impressive number can be credited to the clear message conveyed by the national government, expressing their strong ambition for China to be at the forefront of electric vehicle technology. Additionally, local governments eagerly seized this opportunity and actively invested in these small companies. As early as 2010, China's strategic vision recognized new energy vehicles, or NEVs, as one of the crucial sectors falling under the category of strategic emerging industries. The Chinese government saw the potential of new energy vehicles, which include electric, hybrid, plug-in hybrid, and fuel cell cars. However, over time, the government's support shifted mainly towards fully electric cars. To show their support, the government implemented various measures like subsidies, tax breaks, procurement contracts, and other incentives. As a result, many domestic EV brands emerged and worked hard to improve their technologies to meet the practical needs of Chinese consumers. This effort also attracted a significant number of young car buyers who are increasingly interested in electric vehicles. The Chinese government has been investing in EV-related technologies since 2001. EV technology quickly became a priority in China's 5-year plan, which is the country's top-level economic blueprint. In 2007, the EV industry received a significant boost when Wang Gang became China's Minister of Science and Technology. Wang, an experienced automotive engineer who had worked for Audi in Germany, had a strong interest in EVs. He even personally tested Tesla's first EV model, the Roadster, shortly after its release in 2008. Many credit Wang with a crucial decision to wholeheartedly embrace electric vehicles at a national level. Despite the initial success out of the 487 companies, only one is profitable today. Recent statistics show that only 40 companies are still operational, meaning 447 of them have gone bankrupt. Among the 40 companies, only BYD is currently making money from EV sales. It's important to note that while some other companies may succeed, making money from EV sales is extremely challenging. Tesla and BYD are the exceptions, as they have achieved profitability. However, when we compare the operating profit margins of the Chinese companies to Tesla, there is a significant gap of 14 to 74 percentage points. Despite BYD's impressive sales growth, the company continues to struggle with modest profit margins, which lag far behind Tesla. Between 2019 and 2022, BYD's gross profit margins for the third quarter ranged from 16.3% to 19.4%. 13% and 15.9% respectively. Its net profit margins varied from 1.7% to 3.8%, 1.8% and 3.7%. In contrast, Tesla's gross profit margins for the same period were 16.6%, 21%, 25.3%, and 26.4%. Its net profit margins were negative 3.15%, 5.2%, 2.7%, 10.5%, and 15.3%. These numbers clearly show that BYD still has a long way to go in terms of cash flow. The difference in financial performance between these Chinese companies and Tesla is substantial, amounting to as much as 16 to 20 billion US dollars. This year, many Chinese companies, especially emerging car manufacturers in the second, third, and fourth tiers like AI Ways, Leapmotor, Weltmeister, Skywell, Hozon, Cytec, and Future Mobility, have faced significant disruptions in their capital chains. These disruptions have made it difficult for them to sustain their operations and navigate the competitive market. One major challenge these companies face is the lack of capital. Even after successfully setting up production facilities and obtaining qualifications for vehicle manufacturing, many of these companies find themselves constrained by insufficient funds for product development and expansion. When a company lacks capital, it can struggle to maintain high product quality standards and competitiveness in the market. As a result, sales decrease and financial losses increase. Companies like AIways, Weltmeister, and Cytec have been struggling with poor sales due to issues related to product quality and competitiveness. These problems have had a significant impact on their financial performance, resulting in losses and putting their long-term sustainability at risk. Although Cytec managed to raise $500 million in Series A funding in 2021, these capital injections may not be sufficient. The electric vehicle industry is fiercely competitive and requires substantial capital investment. The transition from manufacturing small electric vehicles to high-end ones is another major challenge for small companies in the Chinese EV industry. This transition often demands significant capital investments to develop advanced technologies, upscale production capabilities, and establish a brand presence in the high-end market segment. Some companies attempted this transition, but the tails of their newly introduced high-end models fell below expectations, leading to massive financial losses. Leapmotor and Skywell Auto are examples of companies facing this problem despite their plans to target the high-end segment to gain a larger market share. Limited vehicle deliveries pose another challenge for certain companies in the Chinese EV industry. Hozone Auto, for instance, has encountered difficulties in delivering vehicles to customers, with only 900 units successfully delivered so far. In an EV market where monthly delivery volumes often reach tens of thousands, such low delivery figures can undermine consumer confidence in the company's ability to meet customer demand effectively. This can result in reduced market presence, diminished brand reputation, and difficulties in attracting new customers. Factors like production constraints, supply chain issues, logistical challenges, inadequate production capacities, bottlenecks in the manufacturing process, or insufficient distribution networks can contribute to limited delivery capacity. Moreover, traditional car manufacturers in China, including Great Wall Motors, Geely Auto, and GAC Group, have experienced significant growth in their new energy vehicle sales. This not only reflects the shift in consumer preferences towards electric vehicles, but also adds further pressure on emerging companies operating in the Chinese EV market. Despite the challenges faced by some Chinese EV automakers, the overall growth of the Chinese automotive industry is expected to remain strong in the coming years. Several factors contribute to this positive outlook, including strong domestic demand, technological advancements, and an expanding global market share. China's large domestic market, with its sizable population and increasing disposable income, continues to drive vehicle demand. As consumers become more environmentally conscious and seek sustainable transportation options, the demand for new energy vehicles, including electric vehicles, is expected to grow significantly. China's commitment to research and development will have a significant impact on the automotive industry, particularly in electric vehicles and autonomous driving technologies. The country plans to spend 2.8% of its GDP on R&D by 2025, with a substantial portion of this investment directed towards advancements in the automotive sector. This increased focus on R&D will contribute to the development of cutting-edge technologies, further solidifying China's global leadership in electric vehicles and autonomous driving. Chinese automakers are strategically positioning themselves to expand their presence and increase market share in the Middle East. The automotive market in the region is projected to grow at a compound annual rate of 5.2% between 2021 and 2026. According to the latest automotive report, this growth presents ample opportunities for Chinese car manufacturers to boost their sales and influence in the Middle East. As the region embraces the transition to electric vehicles and renewable energy, Chinese automakers, with their expertise in EV technology and advancements in battery technology, are well positioned to meet the evolving preferences of Middle Eastern consumers. What are your thoughts on this news? Leave your thoughts in the comments below, and don't forget to subscribe to our channel. Now, if you're curious about the future of air travel, click this video right here. Thanks!